you go all the way to the beginning for audience that want to get to know you, are there any simple explanation on why you decided to spend your life investing, looking into finance, and that became your passion?
Well, it's a good question. And as you said, today running a equity fund, the Stolt Explorer, with a colleague, Jarle Birkeland. It's a relevant question. How did I end up here? And for my own part, it goes back to my childhood. I've always been interested in history. I remember reading about the great businessmen of the era back in the days, the Rockefellers and the Carnegies and all that. And going to high school, starting to follow the news, the more daily stuff. And what's better than uniting those two things, right? A lot of history and a lot of interest for curiosity for the daily events. And by luck or not skill, that was the exactly 3 months before the dot-com bubble bursted. Then I figured out what's the best way to unite those two interests. Well, it's been buying stocks. And I think I nailed the top of the dot-com bubble by 3 months or something like that. So a learning experience the hard way, that dot-com bust.
True. I think in Norway we have some similar stories, but I think like the greatest stories are usually polar expeditions, right? So that's like, yeah. So, okay, it's December, we're rounding up 2024. Just like as an investor, how is this month in general? Is it like now you probably know the returns? Is it like to just like get everything in place, or is it urgency to get
going? Well, it's been a good year, right? So our fund, Stolt Explorer, is knocking on 20% return this year, and I think we had a constructive view going into the year because we exited 2023 with like good earnings speed, which is the key thing we look at. Valuations were okay going into the year. So if you look at returns this year, half of it, approximately half, has been earnings going up. Say in the United States as an example, about 10%, and then the multiples had done the other part of the heavy lifting, and then you end up north of 20% in the United States in particular. But going into 25, I mean, we like a lot of the trends we're seeing, right? Particularly, the United States seems to be continuing the strong earnings power, but in our fund we'll be looking at Europe, which has been a region that definitely been getting its share of criticisms and negative publicity. But even in Germany, which has clearly been the short end of the stick in many ways, you can find great companies, being it Siemens or SAP, that despite that macro backdrop is able to deliver. And our key job is separating that, call it the macro noise, and pulling it down to the micro and finding good companies that are able to deliver returns despite that somewhat challenging backdrop in those geographies.
Yeah, definitely. So if we go back a bit, because I know, in your life, in your journey as an investor, there's been some moments that has, formed you quite a lot. So if we take the clock back to 2008, you're in London working, can you just like paint the picture? What's your mindset about, what's your mindset, and how did that experience form you?
Right. It's a great question because I think Charles Dickens put it best in his Tale of Two Cities, right? It was the best of times, it was the worst of times, it was the time of foolishness, and it was a time of wisdom, I think Charles Dickens said in his great book. But the reason for saying that is I started working in 2005. And came from this theoretical background, believing in the efficient market, and you could deconstruct risk and all the things you learned at Norwegian School of Economics, the theoretical hat on. And in that period, you saw this run up in financial complex product, right? Into 2008, where it all crashed down. So for me, that was I didn't realize it at the time. That's the definition of a bubble, right? Being inside it and you're not able to detect that you're there. So I'm not sitting saying I called anything of that. I didn't. I was too young and didn't. That's the only thing I can blame it on, right? Being too young and too ignorant and not having done enough mistakes. But I worked at Carnegie, and Carnegie is a kind of microcosmos of that because it's like a great company, great colleagues, learning a lot. But it was wrapped in a bad financial wrapper, too much leverage. So Carnegie, the Swedish company, it was listed at that time. They actually went bust. It was taken over by the Swedish government, which exemplifies, clearly what happened to some of the American banks, but this is much, much smaller scale. And I think, Warren Buffett said it best. Financial derivatives, they're financial weapons of mass destruction. And I think 2008 exemplified that, and I lived through it. And, my employer at that time, Carnegie, went bust. But, we were taken over, and it was privatized and sold to the private equity group, Alto, shortly after. So it's not pity on us. I mean, it's not that's not the point. But it was a point for me. It was a realization that a lot of things that we did learn at school didn't apply. It might work in theory, but didn't work in practice. And that was kind of a turning point for me in 08, 09, realizing that.
But in hindsight, isn't that almost like the perfect timing to learn that?
Well, at least being young. I mean, it's better.
Yeah.
It's better than doing the mistakes while you're rather young, right? So that's a good thing. And for me, it was somewhat also a stroke of luck in a way, because that opened my eye for Warren Buffett and that kind of thinking, which is the definite polar opposite of the efficient market, and more believing in the common sense and not too much Greek letters, but rather looking at what the companies actually do rather than financial engineering and putting, which we did before 08, right, wrapping together shit and saying it was diversified because you could read it in the books, which is clearly turned it was just shit but wrapped in different wrapper, and it was still, well, shite. If we can say that on our podcast.
Yeah, totally. So I think, you touched upon it a bit, when you're inside a bubble, super hard to detect. And today, people write about bubble technology, and, I guess there's no perfect answer because we can't predict the future, we only live through it. So, but are there any signs in hindsight that, there's something here we can learn to detect bubbles, or is it, to be honest, very hard to predict bubbles in general?
Well, valuation gives you some yardstick, right? But going back to the dot-com bubble, we're not anywhere near that, right? So valuation, it's not a timing tool, it's just kind of a condition that needs to be there, right? But we're not there. If you're looking at the US market, it's a PE of 22. When the Japanese bubble popped in 1990, you're looking at PE of 60. Same in the dot-com area and all that. So, but anything. Obviously this can be taken into the sky height here from here. But I think that's just one condition, but what you need kind of to see is this sentiment shift, right? Okay, we can debate if Bitcoin is the kind of proxy for that kind of trading activity and so on. But on aggregate, I wouldn't say in looking at IPO activity is rather muted. Credit spreads are still low but okay. There's no sign of stress there. So that's kind of what we're going into 2025 with a constructive view on equities as well for next year as well. But in turning to the bubble part of it, there's known industry. There's a cottage industry, right? People running about and calling bubbles. And I think one of the surest sign that you're not in a bubble is that all these bearish strategists which went into 2024 with a negative view, right? That revise their earnings estimates up or the target prices up. So the last pessimist have become an optimist, and we're not there yet.
Totally. Makes sense. So a final question I'm quite curious about is that, there's a saying that, when interest rates goes up is almost like gravity. So it should take stock returns down. At least that's finance 101. But how can you describe the relationship between interest rates and stock performance? And how that can tie into what we have learned the last years? Right.
And I think, that's what we learn in school, right? The theoretical right thing. And first of all, we need to separate what kind of interest rate are we talking about. Because if you look at the credit spread, which really matters for if you're a company and say you're a high yield company, not an investment grade company, you're a high yield company. In the US, you're talking about 2.7%, 270 bips above the 10-year, right? Which is a rather low number on the credit side. So even though the 10-year yield is high, the credit risk premium on top of that is rather low, right? And if you look at in real returns, the real rate in the United States, again, taking an example, is about 2%. And it costs a company 2.7% on top of that to borrow. And if you invert that, you get a PE multiple of 21. So market is approximately, fairly priced. It's not extremely expensive. It's not extremely cheap in the United States. So that's one way of thinking about the whole rate thing. I think the kind of miscalculation or misthinking that goes on with the rate thing is that keep in mind that the EPS, the growth, it has another part of it, right? As long as the earnings growth is high, what you divide on really doesn't matter that much. So that's the reason why out of a recession, when the earnings growth is low or near zero, obviously what you divide that earnings growth on matters a heck of a lot. So when rates come down, stocks go up, typically out of an earnings, right? Before the macro has turned, that's when rates come down, being a 10-year rates or short-term central bank rates. In that point, rates do matter, right? But if you do an equation and what's on top of the equation is a high number, changing the number on the bottom of the equation, being the rates in a simple DCF model, doesn't matter that much. And again, looking at the United States in particular, it's been double-digit earnings growth this year, and it's looking to be that also next year. So that's just mathematically, it seems to be forgotten sometimes that that swing factor of earnings, that's where we're keeping a close eye on that, matters a heck of a lot more. And the other thing is that it's not necessarily the level, but it's a change in how fast in terms of market reaction happens that determines the price action in the short run.
Yeah, great answer. So if we dive into a topic of what makes a great investor from first principle, what are some of the key ideas for people who are listening who are considering becoming an investor? How would you describe a good investor in your perspective?
Well, first of all, it's not about a high IQ, luckily for me, and anyways, right? And it's like Warren Buffett says, if you have a IQ of 160, you can give away 40 points. It really doesn't matter, right? Above those level. And to make the extreme example of that, I mean, you've seen long-term capital management in 1998 went bust. I mean, they literally had Nobel Prize winners running the fund, right? So it's not about IQ, it's more about the temperament. It has temperament combined with the curiosity and a humbleness. And I think I've done my share of mistakes in terms of being humble enough. And every day in the market is, at least for me, is a part of being humble and reading the information. Because some of the time, or most of the time, the market is the wisdom of market. That's that word. But some of the time, it's like, the crowd's going crazy at the French Revolution or something. I mean, so you need to separate those two things. When is the market telling you something wise? And when is it, going to the guillotine and going crazy? I mean, you don't want to follow that mob, right? So that's one thing. But in terms of the personal part, I think you need to figure out what's your circle of competence? What's one's own interest? And obviously, or not obviously, but it should align with your own interests. And I'm lucky that I don't know much about biotech or shipping. I'm no expert in that. But in some companies and in some areas, maybe financials, industrial, something, those kind of companies, I have an interest and I have kind of a circle of competence. And I don't think it's not the size of the circle, but now it's knowing its boundaries that is key. Because once you start stepping out of that, being because that sector is hot, or someone said something about, and you heard a stock tip. So I mean, then you're kind of really, really going astray, I think. And I think the key, at least for my part, has been the opportunity to keep on learning, right? And learning isn't memorizing a formula or doing some Greek math work or something like that. I mean, Stephen Cohen said it best, right? It's not about, math doesn't give you an edge. I mean, everyone owns a calculator, has an Excel sheet. That's no edge, right? So it's about all these other things, and also things we can work on. And I think, for my part at least, it's been tying that together with a more stoic attitude to the market. Because, the share price doesn't care. I mean, we know what you or I think about it, right? It does what it does. And in the long run, it's a weighing machine. It's not a voting machine. But in the short run, it does all kinds of things. And I think keeping a focus on what can I control, and don't compare yourself to others, right? Keep your own scorecard and don't let yourself be dragged away what other people, I think, that quarter or that year or something.
Yeah, very good answer. So I just wanted to add on that as well, because you mentioned some key attributes, but it's always fun to invert the question in Charlie Munger terms. And what are some of the things you should definitely avoid? How would you make that list? Like things to avoid?
Well, I think well, you mentioned Munger. I mean, there's the three things that can go wrong, right? It's leverage, liquor, and ladies, right? So try to keep those things, not too much of either of those things. I think that's a good start at least. Yeah. But I think avoiding those three things and comparing yourself too much to others. Actually, we have customers, right? So they have we have a promise, and we're going to deliver, and we do deliver a participation in the global value creation. On a risk-adjusted basis. Beside that, I mean, there's always a fund that's going to be better, or someone has done this and found that company. I mean, all those kind of things, which distracts from the real business of the business, which is, for our part, finding good companies, able to thrive despite the macro noise, and focus on those things. What can I control, and what can the company themselves control? Because I think that's the exact same thing, which distinguishes good companies and good investors, and bad companies and bad investors.
Totally. So, I mean, you've been many times to Omaha. So explain, why do you go there every year? What was the first experience like? What do you take away from going there, and why do you keep investing to go there year after year?
Well, rewinding the tape back to 2009, and when things really went astray in the financial markets, and sitting in the midst of that myself. It was a search for something else, right? A kind of a pilgrimage, finding another truth than what we learned at school, which worked in theory but not in practice. And the whole thing about Buffett, Omaha, and all that is a cathedral, is a place for thinking about things that do work in practice, maybe not in theory, because in the inefficient market it wasn't supposed to be like that, and you were supposed to do all the kind of things. So I found it very liberating going there. First of all, because it's not just an annual meeting. I mean, it's like a 3-day event, and you meet like-minded people, and you bump into. I mean, it's a very low-key event, despite being almost 30,000 there. And so this year I bumped into Bill Ackman, and people are walking around. It's a very kind of down-to-earth atmosphere, and people are approachable. But again, it's a bit like going to church. If the message was different every time I went. I mean, that's the whole point of going to church. It's supposed to be the same message, right? And for my part, it's been very back to the Stoic part of things. It's a place where you can once a year calm down, go back to basics, first principles, what really matter, and be reminded of that. And in a way, on a personal level, it's a bit like having two very smart grandfathers. Now Charlie Munger passed away last year, but for many years it was like this smart. Grandfatherish like figures, which has been both a place of learning and a place of contemplation for my part.
And you plan to keep going there?
Yeah, I do so. So we booked the tickets for next year. So it was always the first weekend of May. And if anyone looking for a traveling tip, they're welcome to reach out. And there's some tips and tricks how to spend the weekend in Omaha. But it's definitely to be recommended. And even though sadly Munger passed away last year, so it has changed a bit. The new management team is on stage and so on, but it's still worth going.
Yeah, I've heard people love it, so it's probably for good reason. So now we touched upon, some of your role models in investing, Buffett, Munger. If we take a segue to capital allocation and also making it relevant for people who are tuning in, how would you sort of, go about the principles and how to allocate capital? Because, there's so many angles, age, risk profile. You do it as a professional job, others do it personally, right? So if we look at just capital allocation, what are like the main principles people should think about and consider?
Well, first of all, keeping your purchasing power. Let's go back to first principles, right? And we know what the long-term returns are in the United States stock market. It's 6.5% real returns, then you need to add inflation on top of that. And now we're talking about the last 125 years. So that gives you about 8 to 9% over the long run. The funny thing, in lack of a better word, is that the last 75 years, there's only been 4 years when the return on the stock market has been between 8 and 9%. Why is that? Well, it's not normally distributed. So you need to be able to survive that, or mentally be able to do that. In our fund, what we're trying to do is doing that by having a low standard deviation around the return. So we're diversified on geographies, diversified on sectors. And I think from a Nordic perspective, if you're there, you also need to think about the currency. right? So you have two alternatives. Either you want to hedge your currency, which is somewhat costly and could take away some of the returns, and it's a timing matter as well and rebalancing. This is a lot of, so we don't in our fund do any currency hedging, but we have a kind of allocation to the Nordics of about a quarter and 20 to 25%. Why is that? Well, it's actually, if you do the math, it's better, assuming you live in the Nordics, for example, to have that allocation in stocks rather than doing the currency hedging. That gives you kind of a natural hedge. But another kind of key aspect is that the Nordics is like a mini world. If you're looking outside Norway, clearly in Denmark you have the healthcare industry, which is very strong on a global scale. Sweden, you have both industrial companies and technology companies. Finland, you have a lot of industrial companies as well with a long track record and good returns. So, it doesn't give you, luxury brands and all those kind of things, but it gives you a lot in the Nordics. So that would be my first thinking, having some there. But then at least what we do, we try to expand out from that on a balanced basis. If you just go ahead and buy, at least my first would be, save something, outside Norway. But the problem, if you do buy the world index, you end up with almost 70% allocation to one country, United States. Great companies, but it's had a heck of a journey the last 15 years and starting to become somewhat pricey on simple earnings multiple. So trying to find something more balanced than just going for that would be my idea on a personal level. And hopefully we can touch what should a company do in terms of capital allocation, which is key for the return of the stock.
Yeah. So another part before diving into what makes great companies. What are your thoughts on the debate on active versus passive investing? I mean, we have a fellow Norwegian, Robin Wigglesworth, wrote an amazing book, Trillions, where he dove into how the index fund was created. And what are your thinking of that debate, passive versus active? What should be your general, ideas on it? Super hard to beat passive, or is it okay, if you find an edge, possible, but extremely difficult?
Well, I think on the passive side, I mean, it doesn't really fit with the original definition of passive, because it actually does a lot of rebalancing and trading in it, right? So it's not, but it's putting the semantics aside. I mean, how we think about a company. I mean, you're part owner of a business. In what other senses, if you own the local bakery or something, would you put away all your decisions to someone else? I mean, going back to first principle, owning stocks is owning a small part of a business, right? And owning a small part of the business, someone needs to make those critical decisions. So my key concern with that is that you get more management-run companies. That would be on the longer term, right? That's the one thing. And besides those other effects, as passive takes more, you first of all, you have clearly a momentum effect, right? Which can do something to the price allocation and price discovery mechanism. But I'm more concerned about kind of the governance angle from a shareholder perspective. As more and more money become passive or institutionalized in terms of voting, I mean, it becomes all sorts of issues, not just ESG I'm talking about, I'm more talking about, capital allocation, pay packages, all these kind of things which are important for shareholder return, not letting companies become management run, which I think can be an issue in the passive trend. So those are my 2 cents. But now I'm talking, running an active equity fund. So, you're getting the answers with all the biases coming your way.
That's totally fair enough. So let's dive into companies. I mean, we're going to probably talk about some companies, but again, if we stay to the first principle, what makes truly a great company in your perspective, and how should you detect it?
Well, I think in the long run, the company the returns we as shareholder are going to get are going to migrate towards the returns the company are creating on their capital. So the simple metric, I mean, either a return on equity, and if there's debt involved, return on capital employed. We can go in a bit more detail, but over time, even though if you pay a bit higher price for a company with a high return on capital, your outcome tends to be much more favorable over the long run. I mean, if the company has a return on its capital of 7-8%, I mean, that's probably what you're going to end up with as an investor. So but ideally, obviously, you would like to buy a high return company at a low price. But again, as Warren Buffett says, it's better to buy a wonderful company at a fair price than a fair company at a wonderful, quote unquote, price, right? And going back to first principles, but even on a return on equity basis, keep in mind that's just EPS, earnings per share divided by the book value. I mean, and you can have all these examples of how things can go astray. Take an industry like the Norwegian seismic industry. You had two companies for 25 years. TGS was a capital light one, and PGS owning all the vessels. I mean, in the end, the only thing that went up in PGS was the number of outstanding shares, right? So what happens then if it's earnings per share, so the number of top of the equation, becomes smaller and smaller, and you end up diluting a return on equity. So those are the one of the key metrics. You want to find companies that have a high return and incrementally are able to invest at those levels, ideally without too much leverage, but ideally being able to put a lot of that at work. But the key question is if a company, again, as we talked about having a calculator or saying a company has a high return on capital, I mean, that's not really an edge, right? So the key determinant, and the reason it's useful to study history is when does it tend to go wrong, right? Because if you think about it, it's like if you have a high return, it's like being in a mid-age as castle. Remember all the castles from the Middle Ages, and you have this moat around them. And thinking about it, if you do own that company or that castle, a lot of people will try to attack it, right? If you have 20% return on capital, every Peter, John, and Dick, and Harry is going to try to attack you, right? So you need to have some powers to defend yourself. And I think the framework one could easily apply, and most could apply, would be like Helmer's 7 powers, which tends to be like switching costs, network effects. At least look for one of those things, right? Is there a brand? Do they have a cornered resources? Or is there a processing power? One of those 6-7 called defense mechanisms around the castle to maintain the high return on the capital that you do have. And on that part, that's when it's more art than science, and it helps reading history to study how things went wrong in the past.
And I think, listening to you talking about Moat, it reminds me of like this brilliant quote from Peter Thiel, this great investor that, all great companies that looks or effectively is a monopoly claim to not have it. And all the other companies who really don't have a moat claim to be a monopoly in order to stand out, right? Then we're back to psychology again, which makes this so fascinating that if you're a brilliant company, maybe it's in your interest to not shout it out that much. Take your Googles, your Amazons. They don't really want that perspective on them, right?
No.
But if you look behind, it's like, okay, it's pretty close to something looking like a monopoly.
Yeah, and it's, you're touching, some of those companies, right? They are first of all, there are several companies wrapped into one company, which is one interesting aspect. But the more interesting thing is that many of these companies do look, on first sight, expensive. Let's do an extreme example. Amazon has always looked expensive, right? And in the meantime, they have created this enormous scale effect. Why is that? That's because they've spent a lot of R&D. So in those companies who decipher, is it cheap or not, I'd rather look at, they have a high gross margin, because that tells you, are the customers willing to pay for it? And by high, I mean kind of north of 40 to put a number on it. We're starting to talk those kind of gross margin numbers. It shows a willingness that the clients are, you have customers and clients willing to pay up. So rather looking at, is it expensive on PE, take Amazon for that matter, look at gross profit divided by total assets, and then you can decipher, and will it turn out that, so you don't want to punish companies that invest a lot in R&D marketing for that matter, over their P&L, so they look expensive, but in reality they are creating shareholder value under the hood and building that moat of scale, or brand for that matter in LVMH in France, for example, investing a heck of a lot in commercials, which we all have seen, right, which has a very long lifespan, but it's taken over the P&L each year.
Is Tesla the hardest one to like? Yeah.
That's a tough one, right? And you can always debate what is it really? Is it a tech company? Is it a car company? I mean, it's a car company. It's the most expensive car company. But let's see what it turns out to be. And I think the greatest asset of Tesla is Elon Musk, right? Elon Musk's ability to raise money, and I think that's a good example of the humbleness, at least from an investor perspective, you need to have, right? Because he, as one that has been able to make perception turn into reality by himself, by constantly raising money at higher valuations. He might be able to crack the code on battery and robotics and whatnot, but I think that's a good example of that humble as at least I acquired over time, because I mean throughout the years there's been lots of people should short Tesla because it's expensive, you should short Tesla because of this and that. I mean that's a graveyard of fund managers that's trying to being too smart on Tesla. So I'm humble enough to say it's too complicated.
Yeah,
it's to answer.
What are some of the companies in the Nordics that you believe have the most unique moats in their business?
Well, I think let's start in Norway. I think it's kind of an underappreciated fact is Kongsberg Gruppen, which we all think about these days as a defense company, and rightly so. But keep in mind, defense is only half of the revenue base. The other part is the maritime part. And on the maritime part, so say Kongsberg Gruppen this year will probably do about 50 billion NOK in revenue, about half that is on the maritime side. And on the maritime side, what I think is underappreciated and the moat in that part is the installed base. There's about 100,000 commercial vessels in the world. 34,000 vessels have one Kongsberg maritime product or more on them. So you have a huge installed base, present in 34 countries. So I think what the market kind of missed or keep on missing is that this the breadth and depth of the product offering on the maritime side, because I mean you have automation control, dynamic positioning system. I mean basically everything for a vessel you can get besides building it. Obviously, you can get from Kongsberg, which creates a long-term client relationship, not least in terms of service and aftermarket, where you can have really high margins versus the new building side. And I think they bought Rolls-Royce, right? So they've taken out competitors over the years, consolidated the industry, and in many of those verticals we did mention, talk about being a DP systems and so on. They're of one or two. It's like a duopoly or oligopoly. I mean, that's the thing, right? First you want to look for a monopoly, and if it's not there, you want to look for duopoly, and then you want to look for the oligopoly. And in quite a few of the companies that we own in the fund, it's one of those, not necessarily a monopoly, because then you end up typically in utilities, which is natural monopoly. But if you go duopoly and oligopoly, you seem to be able to make super profit over an extended time and longer time than many people do think. So I think Kongsberg is underappreciated, and the other part, the defense side, we all know that these days. But keep in mind that even though the war and the terrible war in Ukraine should be over tomorrow, you would still have these programs on the JSM and the NSM side, the missile naval strikes missile side, that keeps on going, right, for years and years. And of course the big backdrop being the NATO defense spending. Of the 33 countries, only 23 are up at the 2%, even after all these years, right? So you have these secular drivers that's running behind in the company. And the company has increased the top line by 20% a year the last 5 years. Is that going to de-accelerate? I mean, you're going to go from 50 billion now up to 120 billion in 2033. So then you're looking at the CAGR of 12% only. But I think it's a good example of a company that looks expensive, traditional multiples, being a PE and so on. But again, if you appreciate how much they spend on R&D, not capitalizing it, and keeping those strong position and product offerings. I think it looks like a decent investment still.
Yeah, and back to your investment philosophy, I know we should not overgeneralize, but this is like when you find Kongsberg, you like the development for reasons explained. So is it fair to say that you envision that the fund should probably own that company for a long time? Or is it a point where, okay, share price now looks very expensive, let's sell a bit? Or how does that go into? I mean, no right answer there, but...
No, but let's giving a more extreme example, which has been NVIDIA, obviously, which we have owned over the last couple of years, right? And what happened there is that the PE multiple, or the earnings multiple, stayed basically the same because the earnings kept on growing at the same pace as the share price. So it's only been between 35 and 40 on a simple PE level all the time, despite the share price going ballistic. But now, so typically when that earnings decelerates, which happened the last couple of quarters, that's kind of one of the flags you're really looking at. So it's still good earnings growth, but you're going from extremely good to less good, right? Which tends to be a kind of a difficult transition. And the other reason we sell is we're running a fund, so we need, from a risk perspective, not to have too much weight in one stock. So that would be the reasons to sell. And but besides that, we in the fund, we try to incorporate two things at the same time, both the momentum effect, what kind of risk premium are we catching? Well, the momentum part, because what seems to be happening is that the market is underappreciating good news. Kongsberg Gruppen can be a good example of that. NVIDIA can be a good example of it. It keeps on going, right? And that's why both share price, but also earnings are autocorrelated. I mean, one good quarter, it tends to, in good companies, that tends to continue until something happens, right? But it's more likely that it continues for another quarter. So that's why we try to hang on to those kind of stocks as long as we can.
Yeah.
And it still represents value in the sense that it's below intrinsic value, and it's not in an absurd pricing range.
Other interesting companies in Nordics?
Yeah, I think. I think on the capital return on capital side, I mean, I think one of the striking things is two Danish companies in the same industry, but with very different return characteristics. DSV, the sammenslutede vognmenn, the United Truckers, let's try to translate to English, and Maersk. So joking aside, I mean, it's a good example of if it floats or flies, you should probably lease it and not own it. And I think those two companies, the last 25 years, is a good example of that, because looking at the returns on DSV, which is a capital-light business model, done a lot of M&A, but stayed capital-light, a lot of cash generation, debt has not grown out of place. The stock has returned 20% a year over those 25 years, which is magically is the same as the earnings number, which is compounded at 20%, which magically also is the same as the return on capital in the business, versus Maersk, which has returned 6-7% a year. So point being, over 25 years, that compounding effect is enormous. So Maersk has only gone 300%, right, over that 25-year period. 300% sounds like a big number. But if you look at DSV, and it's gone 10,000% in the same 25 years. So Einstein he said it, right? I mean, compounding is the eighth wonder of the world. And I think being in the same industry, basically moving stuff, but with a very different business model, capital light versus capital heavy, over the long run, it shows the discrepancy between those two kind of business models. So we own the DSV, a great company, and this fall bought DB Schenker. So now the biggest freight forwarder in the world. So it's congrats to the Danes, great businessmen, and they seem to be able to continue that journey on a good cash flow basis.
And that's one story that is incredible, of course. And then it's hard to talk about Denmark without mentioning Novo as well, I guess.
Well, I think we need to touch on that. And then we were told you never mentioned the duopoly, and the funny, in lack of a better word, is that the same two companies, which for 100 years had dominated the insulin diabetes part, Eli Lilly in the United States, Novo Nordisk in the Nordics, dominated the insulin industry, seem to be the ones dominating the weight loss, which hopefully, knock on wood, is going to be the next, let's see if it's going to be 100 years, but when we meet next time, but 100 years of super returns on the weight loss side. And I think also comes to show that it's a combination of good owners, which I think is a key aspect. When you asked about a good stock, what is that? I mean, being a good stock often requires to have good owners. Good owners require long-term owners on the board that are active. You asked about passive versus active, but I think this is a great example of having active owners. There is a foundation, that's the main owner in Novo Nordisk, which has probably enabled the company and the management to take these long-term views. The Wegovy, for example, that's the weight loss medicine in sale today, started developing it almost 30 years ago. So these are huge, investments in long term. And if you don't have a board that allows the management to take these long-term value creation decision, it's very hard for the management to operate without that kind of good parenting, call it. So I think it's a great example of great ownership, great business culture, great products, and knock on wood, hopefully they will dominate those two will dominate the weight loss industry for the coming years.
Yeah. I know this is a very hard question to probably answer, but if we're talking about Moats, and then in Norway we have the salmon industry that is obviously well known worldwide, and then there's so many things we could discuss with tax, with land-based farming, but like salmon industry, Norway, do we define that as a very strong moat and we see good times ahead, or is that a more complicated one?
Well, I think turning back to the framework, Hamilton, the framework, 7 powers. So location, I would qualify that it's called cornered resources, right? It could be a patent or it can be a location, something that can't be taken. You've cornered it. And for some of the companies, SalMar in particular, they seem to have cornered some very good locations. I mean, the water quality is good, the temperature is fine on their location versus some of the other fish farming companies. So I think that's an example of an industry which has taken some of the best maybe from offshore, other related industries. I mean, this is a question: what are we going to do after the oil and all that? I mean, I think the answer is, among other things, it's the fish farming part of it. And looking at some of those companies that are best in class there, you're talking about great returns, right, on capital employed, SalMar in particular, and they've been able to grow as well. And you mentioned tax. I mean, the growth vertical that before this new tax change was this offshore part, which I think could have been a great growth area. Unfortunately, now it seems like that growth is going to happen in Scotland, Ireland, and in other locations, right, than the Nordics, because of that tax angle. So, we own SalMar, and it's one of those owner-operator companies that tends to do a bit better because you have Gustav Witzøe, which is, in his 70s, but still active. And that's, you again, turning back to what do you look for in a great company? And one of those things is either a good owner or owner-operator, in the sense of Gustav Witzøe, in that which influence the culture and the capital allocation part of the companies. So we're happy holders.
If we're looking ahead, let's say we soon about to start 2025, what are you personally most excited about? And then we can also do the segue into building Stolt Explorer, which is also a very difficult job building an independent fund, right? But how would you summarize what are you most excited about for 2025?
Well, I'm excited about the companies we own. We have assembled, I think, a great bunch of companies, and most of them are on a great earnings journey. And then we have found, some companies, we touched in on Europe, which haven't, 2024 has not been their year. I'd like to, point out ASML in Europe, which is the Dutch maker of these EUV machines. It's been basically zero, so it hasn't delivered, for us. And so it's been disappointment. LVMH has been a disappointment. So I'm a bit excited about, what's Europe going to do next year, right? And specifically with this Mario Draghi report we had, last couple of months about productivity investments in Europe, tax, innovation, all that part. I'm excited, is that going to filter through to the politicians, going to filter through to, if you mentioned in Norway tax, not at least, right? It's 2025 going to be the year where Europeans, including Norwegians, going to wake up to the fact that the US is running ahead of us on all these, productivity, growth, and all these parameters. So, we have a great bunch of companies, and then they, with great management, but some of them haven't delivered, and then knock on wood, 2025 will be those the laggards year.
Yeah. And what are the most important milestones for Stolt in your setup?
Yeah. So we're an independent provider. We have an equity fund, Stolt Explorer, and our job is solving a problem for clients, right? So we want to make it easy, like a one-stop shop for clients to participate in the things we talked about, global value creation over time. And the way we do it is by having we're not out to getting all too theoretical, right, and throwing numbers here, but we have a low standard deviation. So we're looking at 20% return this year, but we have a 10% standard deviation. So going back to school, that will give you a Sharpe ratio of about 1.5, right, assuming the risk-free rate about 5%. So what we're trying to do is solving the problem for clients that want to participate. So we need to get that message out. Because I think far too few people, especially in Norway, do this, the usual savings and the savings abroad to participate in the global value creation. So we have created, if you visualize it, our Stolt Explorer is like a cable car, not a roller coaster, right? So, some people like to go joyriding. That's not, that's another game. That's not the game we're playing. It's not the vehicle we have. We have a cable car, not a roller coaster. And I think I'm excited about getting the message out because, hopefully it solves people's problems in terms of pension, it solves people's problems of, keeping your purchasing power if you're young. And we're on the fund management side, we're two guys, this is Jarle Birkeland and myself, and we have two other great colleagues, but we're partners. So our incentive are the same as our clients. So we don't have any institutional ties. We're thinking about our clients as our partners more rather than customers, and trying to build long-term relationships. So that's what I'm looking for. And talking to you or talking to clients, that's the best part of my job, or being at one of your meetings or meeting new clients. That's the great part of my job, and having these kind of discussions. It's what I'm looking forward to in 2025 as well.
And it's a bit fascinating because one thing is, of course, you have the deep passion for investing and being an investor, but building up a fund, you also get to be an entrepreneur, right?
Yeah.
That comes to doing all different kinds of tasks, right?
It's a good point. It's like being, you're both the pilot and then you're the service guy and then you're selling tickets. And so we're two guys doing the fund management and the two other guys helping us with some of the practicalities. But still, everyone needs to, all hands on deck kind of thing, which makes the fun of it, some fun. And it's a bit of a sad thing in Norway, right? We should have had a bigger industry in terms of investment management. Maybe all the preconditions we have, the wealth fund, even though they invest in Norway, but the oil fund, and it should have been a lot more. But instead, we're seeing the opposite, right? We're seeing Norwegian funds going to Sweden, going to Luxembourg, going to Ireland for tax reasons, practicality reasons, regulatory reasons. It's a sad development, right? There's Norway, we should have lots of entrepreneurs. Just over the last 10 years, there have been a handful, right? We know all their names. There's been, Morten Astrup has been a guest here, right? But there's not that many. It's rather a sad thing for Norway as a nation, right? And we should, have, what do you hope for in 2025? Hopefully politicians that enable entrepreneurship, including in the financial industry, would be my New Year's wish.
Yeah, I think that's the perfect way of approaching it. So just a final question. We usually ask guests for book recommendations. What can you recommend people to read over Christmas and starting the new year with new knowledge?
Yeah. How much time do you have? How long is your Christmas list, right? No, but there's no better, as we started with, there's no better teacher than history, right? And the reason being that history doesn't repeat, but human behavior does, right? So what I like to find is like books that are written by people with real experience from the market. Unfortunately, Warren Buffett hasn't written his own book. He writes these yearly letters, but an easy way to access those letters based on thematics and so on is the book called The Essays of Warren Buffett. Lawrence Cunningham is the author, because he has done the job. It's the 8th edition now, which is in print. It was last year. So you can easily see all these different themes, or it's organized in a very readable way. And talking about people with real life experience from the financial market, Howard Marks' book, I think it's a great read of how to think. It's called The Most Important Thing. So it's a great book about how to think about things, second level thinking, challenging conventional wisdom, and so on. And on some of the companies we touched in upon, I think the book called Quality Investing, which goes more into depth of it, Atlas Copco, some of the Swedish great company, Atlas Copco, Assa Abloy, Kone in Finland, Wärtsilä as well. So those three I think would be from a different bit, but all written by practitioners with real life battle scars and experience, which are great entertaining reads as well.
That's the perfect ending. Bernt, thank you so much for taking the time. It was wonderful to have you on, and good luck in 2025.
Great being here. Looking forward to coming back, and Happy New Year.